Hi, Ted Dixon here with an update on the Canadian mining opportunity, which we first wrote about in our March Top 20 Mining and Crypto Report. Provided an update on that theme in our April 7th market update. A lot has been happening even since Monday, so I thought I'd package it together into an update here for everyone. We have two big risks that are confronting mining investors right now. They are tariffs and interest rates, and I'll get to interest rates in a minute. I just want to talk about tariffs because there's so much going on with tariffs and lots of headlines throwing around, and I want to give you my little framework that I kind of put together based off of some recent developments, how I'm looking at it. I'm using a tightrope analogy. Essentially, I see the Trump administration walking this tightrope where it's trying to push forward its tariff policy, balancing on the right its desire to move the budget deficit lower, and on the left to bring back more manufacturing jobs to the United States. So it's walking down this policy tightrope, and the big risk is recession falling off the tightrope. And I think that's why we saw a lot of the market jitters earlier this week, because of the size originally of the tariffs. They increased the chance of recession. We saw a rally on Wednesday once some of those tariff amounts were paused, which I think rightly participants in the market sense that, well, this would lower the chance of a recession. However, the recession risk is still there. How I come to this tightrope analogy was based off of some remarks made by the chairman of the Council of Economic Advisors on Monday, Steve Moran. Those remarks were posted on the White House website, so they obviously carry a lot of weight. In his remarks, he referenced a paper. It was a paper called Trade Wars with Trade Deficits, and one of the co-authors was Paul Pujolas from McMaster University in Canada, as an interesting element to this development. So in this paper, one of the aspects of its conclusions is that the US could be better off if it implements an optimal level of tariffs and redistributes those tariffs to households. The big risk right now, I believe, with the recession in terms of the tariffs is because, in part, this money that would be collected and is being collected now by the government in the United States is not being redistributed to households, because while the administration, the Trump administration, can collect the tariffs, they cannot redistribute it. They need Congress to do that. And until there's a budget vote and a budget put together, they will not be able to take this tariff money, which is substantial in the billions and billions of dollars. This is basically money that's being paid by US importers. Now, whether a country lowers its price or not in response to the tariff is one thing, but the actual tariff tax is paid by the Americans, and that gets put into the government bank account. And unless that money gets redistributed to the economy, it's really a form of austerity. So until we get a budget and we see how this tariff money would be divvied up, there is going to be additional risk with the tariff situation. The other aspect of this paper, which is very interesting, is that it comes to the conclusion, based off of a lot of assumptions, that 10% tariff would be about optimal, about 10% would be optimal for the US. So when you hear this 10% number being thrown around about reciprocal tariffs, there is some academic foundation for that number, it appears. Now, whether this is just coincidental or whether the paper is actually driving the thinking, I don't know. But this paper is very, very helpful in terms of trying to make sense of where the administration is going, because it's so chaotic with all the different headlines coming out the way Donald Trump does his negotiating style. It could seem very chaotic, but it seems like there is a foundation towards their thinking, and Steve Moran provided that, I believe, on Monday. The other big risk is interest rate policy in the US set by the Federal Reserve. I think Jerome Powell is playing a game of chicken with the administration in a sense. On Friday, last Friday, he had a little chat and basically said the Fed isn't going to do anything until they figure out what's going on. So we're stuck with a Fed that, by its own admission, is in a relatively tight position in terms of monetary policy. That is not good for stocks, is not good for mining stocks. Threat of recession may provide some comfort to gold miners, but in general, for the mining opportunity right now, it would be helpful if the Fed were to loosen policy. So until we get to that stage, that will be a definite headwind. Now, what about some of the opportunities? Well, within this tariff trade war that's happening right now, we see that critical minerals are a part of it. In fact, China included rare earth minerals as part of its retaliation in limiting exports. This should get investors thinking about how important these minerals are. In addition, in the recent market sell-off, copper prices fell, and there was also an exemption granted to copper in these reciprocal tariffs. So a lot of copper miners were sold, including ones in the United States. I believe that may be premature because there is currently a national security investigation in terms of copper going on. I expect there will be some form of copper tariffs in the United States, whether it's to all countries or certain countries, we will have to see. But this sell-off in the copper miners may be an initial opportunity actually for those with the risk tolerances and the timelines to kind of look through these initial risks of the potential recession with the tariff policy and also the higher interest rates. Now, there's going to be a lot of volatility again, and there's no guarantee that the stock prices can't keep going down here. They very well could, but we will have to see. The other major positive that we see right now developing is Canadian policymakers are talking very positively about supporting resource development in this country. Both the Conservative leader Pierre Poilievre and the Prime Minister Mark Carney have been promising faster resource project approvals. The key here will be for them to deliver, whichever one is elected. That's why I would really encourage any mining participant, mining investor participant, whether you're a CEO of a mining company or just an investor, to really press your local candidates on this issue and let them know how important it is, so that whoever forms the government, that they keep this in mind. As soon as they form the government, there will be other challenges that come up. It will be easy for whoever forms the government to kind of forget about this. And it is really important for the mining industry to not let them forget about this. It's really important. So there's only going to be a few things that will stay top of mind with the next government. This has to be put in the forefront. Finally, we have the prospect of a weaker dollar in the longer term. Steve Moran, in his remarks on Monday, singled out the dollar as being too strong. He said, the reserve currency status matters, and because demand for the dollar has been insatiable, it has been too strong for international flows to balance over 5 decades. Now, I don't think those remarks would have ended up on the White House website unless the administration was willing to accept a lower US dollar. We will have to see if that plays out, but if we do get a lower US dollar, that would be positive for commodity prices, as a lower US dollar would make them cheaper for other countries to buy. If it does happen, it will be a tailwind for the mining opportunity set in Canadian mining stocks. That wraps it up. Thanks for stopping by. If you're interested in getting insider insights in an easy-to-use format, make sure to check out CanadianInsider.com, sign up for an intro membership where you can get a free starter list. If you're looking for sophisticated tools and data downloads, check out inkresearch.com. Until next time, take care.